Welcome to Bravisa Temple Tree's weekly market update. After a brief correction, markets went into a rally this week. While the bad news is that this uptrend is not likely to continue because of the various negative factors that has been playing in the markets now. Crude oil and the rupee had a sort of cool off this week, while that is only to go up again. The next time crude and rupee goes up, we expect it to get more weaker and start to fall from there. While this might take quite some time, probably a couple of months from here. So this is going to be a pain period for our country where crude oil is expected to touch $100 and Indian rupee is expected to reach 70. Once at that level or probably closer to that level, markets in commodities as well as the currencies will likely to be are expected to be correcting, and that is where bullishness will step into the markets. The final outcome of Karnataka elections have brought in big challenges for the BJP at the center. There were some opinion polls conducted recently after the elections which shows that only 47% of our population is now willing to give the BJP its next term. It has now become that BJP at one end and all other parties of our country on the other side. All other parties joining into an alliance to have a single objective to defeat BJP is actually going to take away vote share for BJP. This outcome is not going to be a good one for the country as well as a bad situation for the markets. Don't know what would be the outcome, while one thing is for sure. Flow of good news for the markets is going to be delayed. Fund managers are of the expectation that next 12 to 18 months for the Indian markets is going to be flat. PSU Banks are continuing their destroying wealth journey. SBI, Bank of Baroda and IDBI together announced another 15,000 crores of losses this week. This adds to the 43,000 crores which was reported by other banks earlier. There is some good news here that the NPA cycle is almost about to peak. Probably another 2 or 3 quarters of losses, and from there banks will be attractive investments. So this is also coinciding with all other expectations on the currency, crude, political uncertainty, everything together, and expectation fund managers have in the market the next 12 months flat period. So this banking sector rally also will start probably in the next 12 to 13 months time. Tata Steel taking over Bhushan Steel brought in big confidence for the public sector banks because 32,500 crores of bad loans in their books have now become good ones. This positive confidence took the PSU banking stocks to a bigger number. Stocks started rallying while their private counterparts began to lose, going into a correction. There was news in the papers that Indian markets have made 520% gains in the last 14 years. This is 3 periods of 4 years after the elections. Once this was told to an investor, he asked me a question. When so much growth is there in the market, why is it that investors have always been losing money when they invest into the market? Markets have always been rewarding its investors with good profits. Only that people have to stay invested to reap these big gains. It almost always happens that retail investors wait for a lot of confirmation before deciding to invest into the market, and when they decide, market is almost at its peak. Subsequently, when there is a correction, they are left to stare with huge losses on their investments, which brings fear in them, and they take exit right at the bottom of the market's correction and are out of the market when the market begins to do its next rally. At the time of taking a decision to invest in the markets, almost all the retail investors come with the decision that I will stay invested in the market for a longer time. and I know that market is going to be volatile. So long the markets are going up, they are happy with it. Once there is a tick down, all their commitments go out of thin air. The result is that almost always these investors tend to be losers in the market. A data on the multiplication of wealth through various asset classes shows that stocks have given 260 times multiplication of wealth in the last 37 years. The last 37 years, of course, this number shows a fantastic gain, while this 37 years did have a lot of ups and downs. For those who stayed invested in the market, have made all these big gains. For those who have not, these numbers stare at them. People say that real estate has been a better investment than stocks. Real estate in India has given half the returns what stock markets gave. The reason why people made big gains in real estate was that they are forced to be invested due to liquidity issues. 1 lakh invested into real estate 30 years back got valued and sold at 1 crore after 30 years. Same money, if it was invested into stocks, it is today valued more than 2 crores. The reason why people did not make money in stocks or stock investing is that because of its liquidity. Price quotes are available for stock investments every minute, and there are buyers and sellers available every moment. The moment an investor sees a negative tick on his investment, he goes out and sells his investment. If suppose real estate also had similar kind of real time prices available, 100% probability is that no good money would have been, or no big gains would have been made into real estate also. So staying invested is what brings big gains, and stocks have the highest advantage of giving the biggest returns on any investment. Presently, the markets are into a correction phase. It is almost repeating the same pattern that happened in 2015-16, where SENSEX dropped down from its peak of 30,000 to 22,500. This correction took a little about 12 months for the markets to reach 22,500, and from there it took a total of 26 months from the previous peak of 30 to breach that peak. And once 30,000 was breached, it just took 10 months to reach 36,000, a 20% gain in 10 months. For those who had invested into the market when the market was at 30k, their investment at present is 20% up. If suppose the same patterns repeat again, by 2021, Sensex will be at 43,000, and these investors who entered at 30,000 will have made 40% gains. So you will think 40% returns in 6 years, it seems to be small, right? For those who have already seen 30% in 1 year, which happened in 2017, one thing which we should have in mind is that we cannot have continuous repeated years of big gains in the market. This return, what we are talking about, is the return a common investor can make by being invested into the Sensex without doing any account management.
For an SIP investor, their returns will cross the 60% mark because they get more number of units when the markets are down and lesser when the markets are up.
Well-managed portfolios like ours have made 200% gains in the last 5 years, which was possible because of being invested into the best of industries and sectors on a continuous basis. So, continue to be invested into the market with review and churn wherever required. For SIP investors, please continue your SIPs, as this is the period where your SIPs will pick the bottom, have more number of units, which will help you reach all your financial goals with very less investments. The pain of seeing negative returns in your investments is only for a short term period. 3 to 4 years from now, your investment would have added phenomenal gains, which will make you proud that you were an investor at the right period. Thank you.